You're going to be staying up, of course, over in the U.S. on this Fed decision. And I have to wonder, is 75 basis points, can that actually be seen as dovish?
It's great to be on the show. And yes, we actually think when it comes to this particular meeting, even though not too long ago, a 75 basis point hike would have been almost inconceivable, at this point, if the Fed hikes by 75 basis points, gives us a reasonable idea of what to expect in the meetings to come, and couples that with some fairly consistent projections when it comes to inflation as well as the rate projections, markets will look at that in a relatively benign way. So we see in particular room for rates volatility to top out, and that in turn maybe is opening the room for rates to end their meteoric rise, and that could push down the dollar and push equities up. So we see maybe counterintuitively room for a dovish surprise to a very high rate increase. But I should add, that's in fact been the norm. 4 out of the last 5 meetings, we got some measure of a dovish market response, even though the Fed meeting itself was relatively hawkish.
Yeah. And since March, they've been telegraphing, look, it's going to be gradual, 50 basis points, 50 basis points. I wonder in terms of credibility, if they do go for that supersized hike, I mean, what does that do to sentiment? Who is setting policy now? Is it really markets?
So I think a couple of things are worth keeping in mind. So they moved on from gradual. Expeditious was the new word. That was the 50 basis points. Now they may need to find a new slogan to refer to the 75 basis point hikes. But when it comes to their credibility, they really need to choose the lesser of two evils. If they hike by 75 basis points, they have to justify it, and they have to refer to that big rise in inflation, the big rise in inflation expectations, and the change in the data dependency that Chair Powell highlighted. If they were to hike by 50 basis points, we will all be arguing that may not be enough in response to the data that we have seen. So that in turn could challenge the Fed's credibility as well. So we think in this market environment, actually a 75 basis point hike will be less concerning in terms of credibility than going by 50 basis points, which at this point would be a shock to markets or a bigger one tomorrow.
And can I still buy the dollar then, Ebrahim, just to play it safe? What could actually foster a change in what the current narrative is right now?
So we see strong upside in the dollar in the coming months, and that's predominantly because we're very bearish for risk assets globally. So the dollar is a place to hide, but it is also benefiting from the fact that none of the other hedges seem to be working right now. Global bonds are selling off, the yen is selling off, so the dollar is the final hedge that's left standing. So we do think that there's still a good case to be buying dollars. That being said, I wouldn't be buying them tonight into tomorrow's meeting. So there is room for a bit of a relief rally all around, again, in an environment where we just passed this big risk event. So there might be a bit of a dollar retreat, but we still see much further upside ahead.
We're waiting for any kind of lines crossing from the BOJ in just a few seconds, Ebrahim, on whether they're going to continue to buy more bonds. You're saying it might not be time to chase the dollar-yen rally. Hold on a second here. They are offering now to buy 150 billion yen of maturities of over 25 years of JGBs. So it seems like we're continuing to see the same of what we've seen all week, basically continuing to offering to buy more bonds. Walk us through when we'll actually see a peak in dollar-yen, Ebrahim.
So we think the peak in dollar yen requires one of two things to change. It's capping global yields, because that's really been the driver of dollar yen. It accounts for maybe 3/4 of the rise in the dollar yen, or for the BOJ to change. And we think that's not likely this week, but we saw a couple of interesting remarks by Governor Kuroda and of course a few people in the government that to us suggest that even though we still see further upside in dollar yen from here, we think we will see 140 over time. This will be the final leg in the way up for dollar yen. So it's worth looking at that policy reaction this week, even if it's not quite the turning point that some are looking for.
Here we go when it comes to your renminbi fix here, 675.18 this morning. The estimate was for 75.24, so slightly stronger than what the survey was suggesting, but we continue to watch a little bit of strength in your offshore rate, 674. We're floating around 675 ahead of the Fed day, of course, today. Still with us is Citi's global head of FX analysis, Ebrahim Rahbari. Ebrahim, I know you watch G10, but I know you're watching renminbi very closely here. I have to throw up a chart that kind of shows this deep discount that we're seeing when it comes to that spread between Chinese one-year bonds against treasuries. It seems to be that there's only one direction for the renminbi at this point. Are you seeing signs that perhaps that gap can narrow?
Yeah, so we think policy divergence is really what's driving dollar-China directionally at this point. So we do think it is that differential between the US and Chinese yields reversing that tells us there's pretty much mainly one way to go for dollar-China, and that's upwards. But we also have to keep in mind that most of the time, the direction of dollar-China is being driven by the dollar. So if you were pessimistic on the dollar, which we're not, then that could outweigh policy divergence. For now, we think that rate differential tells you that dollar-China needs to go higher.
Given that yen is at 134, 135 right now, how do you see that spilling over to the likes of renminbi? Because back in April, we certainly saw quite a bit of a knock-on effect. Could that happen the same way this time around?
Maybe not the same way, but we do have something similar in mind. And we are, as you said, we are approaching the April highs in China yen, which also are the multi-year highs. And in both of those cases, both a few years ago and in April, that was the point of reversal for China yen. So we think one of the reasons why we see renminbi downside here is in fact exactly because we're seeing China yen at highs that I think policymakers in China will find hard to tolerate in this environment.
Are you expecting more policy stimulus for them from China? And how much further to go could renminbi get?
Yeah, so we expect more stimulus on all fronts. And famous last words before the PBOC decision, but our colleagues do expect that the policy rates come down by 10 basis points. We do think we'll get more infrastructure stimulus over time as well, as support for the economy will grow. But in the end, the exchange rate will be driven more by that policy divergence. So we think dollar-China will end up closer to 7. Will it be just below or could it go above? It's harder to say, but there's quite a bit of room between now and then.
There's been a big bond sale when it comes to offshore renminbi sovereigns. I think it's a huge test here, given what we've seen in the debt markets in China, also just ahead of the Fed as well. What sort of gauge do you think there will be? What kind of appetite will be for this sort of for these kind of bonds right now?
I would say it's very hard to say, because as important as occasion may be, it will be a very noisy gauge, simply because if you look around, global rates are looking for an anchor, and they've been desperately failing at finding one. So I think this bond sale is more likely than not to go fairly relatively well. But no matter how it does, I think it's really the global conditions right now that are uncertain. Global investors do want to buy Chinese bonds because, again, there is a central bank that's easing when everybody else is tightening. So you should be expecting rates to be capped. But again, today may be very noisy just because of the global conditions.
Yeah. I have to wonder, too, when it comes to just dollar strength versus everything else, what do you have the most conviction at the moment? I know you're still quite bearish when it comes to sterling.
Yeah, so if we had to pick one currency, particularly in G10, where we see where we're most confident about further downside, it is sterling, because it is a currency that is still a minor reserve currency, that it's a status that it's losing. It has a current account deficit that's probably about to double over the course of this year. And it has a central bank that's frankly undecided whether it needs to support growth versus tackling inflation. And the example of the yen is showing how markets are penalizing that type of attitude potentially quite severely. So we see significant downside in sterling, pretty much against the other G10 currencies, but particularly against the dollar.
One of our MLI Pulse surveys for this week has been kind of where sterling is going to be. Do you ever see cable ever trade back to that pre-Brexit level of 145? I'm guessing you're going to say no, but what would it actually take to get back to those levels?
So I would throw in two candidates. The first one would be in a generalized dollar weakness environment. And we do think over time, the dollar is likely to mean revert, but that would significantly support sterling in return as well. And the other is that sterling was a value trade, both across UK equities, but also in FX. So if we're in an environment where value assets will strongly perform, I think that would be an opening for sterling. But right now, we don't expect either one of those to come through.
All right, Ebrahim, hold on a second. We did get that MLF crossing here on your Bloomberg, conducting that $200 billion renminbi of one-year MLF at 2.85%. So unchanged for the 1 year, which was expected. Ebrahim, you mentioned it's such a busy, noisy day. I'm guessing if they were to actually cut today, that would have been a bold move ahead of the Fed.
It may have been, and that may have well been enough for them to stay the course at this point. We've seen a couple of occasions where we were maybe a little bit impatient in expecting these policy rate reductions. That being said, I think the willingness to allow the exchange rate to depreciate a little bit is going to be there. The willingness to support credit and the broader economy is there. So we think rate cuts will come. It's just a question of time.